Welcome again, dear students and scholars. I hope you are doing well and enjoying the US GAAP journey. In this video, we begin ASC 275 Risks and Uncertainties. This is a disclosure topic, so the main question is not what journal entry do we pass. The better question is what uncertainty should users know about so they can judge future cash flows, operations, and reported amounts more intelligently. Think of ASC 275 as a professional filter. It helps preparers avoid both extremes, hiding important risk and filling the notes with every possible fear that may never matter. ASC 275 exists because financial statements should communicate useful uncertainty, not every possible risk in the universe. Every entity faces competition, regulation, market change, supply problems, employee issues, technology change, and economic pressure. If every risk were disclosed equally, users would drown in noise. The standard focuses attention on risks and uncertainties that are relevant to the entity and useful to users. In other words, good disclosure is not about saying more, it is about saying the right things clearly. The scope rule is our starting point. ASC 275 applies to GAAP financial statements, including annual financial statements and interim financial statements. It is not limited only to public entities, but it does not apply to condensed or summarized financial statements because those reports are intentionally shorter and do not carry the same full disclosure expectation. So the first exam checkpoint is simple. Are we dealing with full US GAAP financial statements? If yes, ASC 275 may apply. If the statements are condensed or summarized, this topic is not the driver. Now let us protect the boundary. ASC 275 does not cover every risk just because the word risk appears in the question. Risks related to management or key personnel are excluded. Proposed accounting changes are excluded. Internal control deficiencies are excluded. Possible effects of acts of God, war, or sudden catastrophes are also excluded. Those matters may still be discussed somewhere else, depending on the facts and reporting environment, but they are not ASC 275 disclosures. This is a common exam trap. Do not turn this standard into a catch all risk note. The best mental model is the disclosure filter. Many risks enter the top of the funnel, but only selected risks should come out as ASC 275 disclosures. The preparer asks whether the uncertainty is connected to the entity's operations, estimates, significant estimates, or concentrations, and whether it has the kind of near-term relevance that users need. Boilerplate language is weak because it could describe any company. Strong disclosure is specific to this entity, this reporting date, and this user decision. ASC 275 is organized around four disclosure areas. First, the nature of operations. Second, the use of estimates. Third, certain significant estimates. Fourth, vulnerability because of certain concentrations. These four areas are the structure of the topic. If you can remember them, most ASC 275 questions become manageable. The key is to avoid mixing them together. A general estimate disclosure is not the same as a significant estimate disclosure, and a concentration disclosure uses a more severe impact threshold. The nature of operations disclosure gives users context. Before users can evaluate risk, they need to understand what the entity does, what products or services it provides, what markets it serves, and where it operates. This is especially important when an entity has not yet begun principal operations. A development stage or pre-operation entity may not have normal revenue yet, but users still need to understand the planned activity and risk profile. Without this context, estimates and concentrations are just numbers without a business story. The use of estimates disclosure reminds users that GAAP financial statements involve judgment. Allowances, reserves, useful lives, warranty obligations, pension assumptions, and many other amounts are not known with perfect certainty at the reporting date. Management estimates them using available information and reasonable assumptions. The disclosure should tell users that actual results may differ from those estimates. This is not an apology for uncertainty. It is honest financial reporting because accounting often measures the best estimate today, not the final outcome tomorrow. Certain significant estimates require more focused attention. Not every estimate needs its own special note. The elevated disclosure is triggered when it is reasonably possible that the estimate will change in the near term and that the change could have a material effect on the financial statements. So ask two questions. Could this estimate change within the near term window, and would the change matter to reported amounts? If both answers point in the right direction, the estimate may need specific disclosure beyond the general use of estimates language. Near term has a precise meaning under ASC 275. It means a period not to exceed 1 year from the date of the financial statements. That is important because students often use vague phrases like foreseeable future, medium term, or next few years. Those phrases are not the ASC 275 definition. The standard gives us a 1 year window starting from the financial statement date. Use that window when judging significant estimates and concentrations. Severe impact is also a precise idea, and it is not the same as ordinary materiality. Severe impact means a significant financially disruptive effect on the normal functioning of the entity. It is a higher threshold than material, but it does not require total catastrophe or bankruptcy. This term matters especially for concentration risk. A customer, supplier, market, resource, or geographic concentration may require disclosure when events in the near term could cause severe impact. So remember, material affects user decisions. Severe impact disrupts the entity's normal functioning. Before we close, lock the concept map into memory. Scope means full GAAP annual and interim statements. Exclusions include management risk, proposed accounting changes, internal controls, and acts of God or sudden catastrophes. The disclosure filter keeps the notes focused and useful. The four areas are operations, estimates, significant estimates, and concentrations. Near term means not more than 1 year from the financial statement date. Severe impact means financially disruptive and higher than material. In video 2, we apply these ideas through examples, illustrations, MCQs, and short answer practice. Please like this video, share it with your colleagues, subscribe to Commerce Regiment, and support the channel so we can keep building high quality US GAAP education.